on Gujarat Gas, and target is 390.
All right, take that point, Sudarshan. Thanks a lot for that. Meanwhile, we'll just keep an eye out on market opening itself. Meanwhile, just watch out for Z. I'm looking at that one. We have, a CLSA note that has come by, which is suggesting that the stock could double from current levels, largely because of the big decline that it's seen. Almost 55-56% decline ever since the fallout of the merger with Sony. Valuation's attractive. We've seen the promoters buy some stake in the company as well. Can things turn around for Z is something that, brokerages are betting on from lows.
Yeah. Do you know who's written it? Is it still, who's the analyst?
I don't think it is the same analyst as it was
I think
earlier,
Dipali
one of them. We'll just try and get some details on that.
Try and have the analyst on as well. And but that's an interesting one. We were talking about bombed out names, right, with Deepan earlier. Well, this is certainly a completely bombed out name as well. So more details on the note as well in terms of exactly what they're saying with Mangalam in just a bit from now. We've got market open a few seconds from now. So 130 points on the Nifty. You've got decent gains on the Sensex. And there's a 0.5% higher open once again. 23,000 plus on the Nifty and 49,700 on the Nifty Bank. The small cap index is up about 0.8%. And 10:1, not 10:1, beg your pardon. It's 6:1 advances to decline, at least right out of the gates in terms of the market open. We'll have to give it some more time for things to settle. But this is a good-looking screen, good open in that sense. Absolutely. 100 on the Nifty and about 300, about almost 400 points on the Sensex is what we have. And I think the broader markets are doing just fine once again. Nifty heat map, if we have it, maybe just gives you a quick sense. I think it'll be all green, mostly all green. Maybe 10, 11 names in the red. Everything else is starting strong. Srubi.
Absolutely. This is a good opening. And off late, the implied open has been spot on in terms of predicting the actual opening as well. Indeed, it's 100 points up and 23,000 is on the screens for the Nifty. IT stocks finally are managing to recover after the drubbing they've received earlier this week. Wipro, Infosys, we were just discussing these names with the analyst at BNP. So there's some buying that's coming back. TCS is also about 0.7% higher. So that's a solid move for the market. And you have banks and financials. So both the twin turbo engines are charging ahead for the bulls. Banks and IT. IT I've mentioned. Let's look at banks. IndusInd is seeing some takers, 1% up this morning. There's ICICI Bank, there's State Bank of India. These are stocks on the higher side. SBI Life from the broader financial universe looking good. HDFC Bank itself is up about 0.5%. Kotak is higher. Axis is also higher. So banks looking quite good. Reliance is contributing, not too much, just about 4 rupees, thereabouts, 4-5 rupees on Reliance. But for what it's worth, it's in positive territory for the time being. Aside of IT, banks and Reliance, M&M, BEL, these are the other gainers. Adani Enterprises seeing some early gains as well. The only part of the market that's a little soft, JSW Steel, some of the metal counters are losing their sheen after yesterday's big moves. L&T is quiet, 0.5% lower. And there's a little bit of red on some of the pharma names like Sun Pharma, Reddy's and Pharma close to the flat line. But otherwise, it's a solid start, 100 points higher.
100 points higher on the Nifty, and it's the IT pack which is leading it. The broader markets have been interesting moves, big moves as well. Z, for instance, we just discussed that pre-open, about 30-40 seconds ago. CLSA is bullish on the stock. It's opened about 4% higher. We've seen some traction in Midcap IT as well. Emphasis, Birlasoft, Intellect, Design Arena, all of them up anywhere between 2 to 3%. But on the way down, I'm looking at all these cables and wires stocks. Yesterday we got an exchange notification from the Adanis that they've incorporated a joint venture for their cables and wire foray. The foray itself was known already, but the action that, they've gone ahead and incorporated a joint venture has the street worried because, again, this is, coming after Ultratech has made their announcement in this space as well. So we have KEI Industries down about 7%, Polycab down about 6%, Havells down about 5%, RR Kabel down about 2%. All these companies have said that for any conglomerate to come in and establish some certain market share out there which could impact the industry is still about 2 to 3 years away, but we are seeing some decline out there. Voltas, healthy analysts meet. Maybe the street does not like the fact that the company is preferring growth and market share over margins, or perhaps it could just be routine profit taking after a 16% up move that we've seen on the stock itself. Jubilant Foodworks down about 2%. Remember, the Turkish lira has depreciated a fair bit, and they had, some exposure to that via their DP Eurasia JV. So maybe a bit of concern out there after the recent outperformance that we've seen. But no such problems for the stocks that have been doing well. Garden Reach Shipbuilders, another day, another big up move, and they've gotten a memorandum of understanding with the Nagaland PWD for supply of 8 sets of double-lane modular steel bridges. So orders coming in thick and fast. Also orders coming in for Paras Defense. That stock's opened about 8% higher at the open itself. 140 crore order, if I remember correctly, announced just before market open today. That stock up 8%. So big moves on both sides. Midcaps outperforming. And as things have settled 4 minutes, 5 minutes into trade, we have 2,000 stocks which are advancing for about 200 which are declining. But the ones which are declining are seeing massive cuts.
Absolutely. And, it's a good-looking screen, 120 points. So despite that, the pressure from, remember earlier it was the Aditya Birla Group with their planned foray into this segment, the wires and cable segment. And that day, of course, stocks fell 8, 9, 10, 12%. And now it's another one. All the biggest volume-led gainers are all these wires and cable companies, as Mangalam pointed out. Mangalam was pointing out right before open, Z started 5% higher and it's got the second highest volumes on the NSE. So about 105 rupees, and we'll have details of what CLSA is saying on Z in just a bit from now as well. That's it. Otherwise, on the upside as well, volume-wise, it's a kind of slow start. But like yesterday, hopefully it broadens out. Eris is up. Eris Life Science is up 11%. And it's got some volumes as well. So that's why I'm making a quick mention of it. That's it. Otherwise, it's a decent kind of start. The number one volume-led gainer is Garden Reach with a 3% gain at this stage.
Actually, that yesterday, PSU move from yesterday, that's kind of continuing this morning as well. So you have some of the shipbuilders, have some of the railway stocks, some of the financial names, so Ircon, etc., IRFC. These stocks are still up and about. So the PSU move is also on. But I think Mangalam spotted the most interesting trend of the morning, which is wires and cables. And I remember what these companies said even after the Ultratech entry. They maintained a very brave face, saying that this will take some time, it won't be disruptive, etc. There was some recovery in the stocks. But the fact is, there have been two huge, big, deep-pocketed players coming in. Perhaps you can't entirely write off the competitive intensity that could maybe unleash ahead. So, yeah, all of them down 4-5%.
We'll keep a track of them. Vineet Sambre is with us, Head of Equities at DSP Mutual Fund. Vineet, good morning. Great to have you with us here. Prashant, this side. Now, let's just actually, why don't we, we'll get to the markets in just a bit, but this, once again, effective competition. Actually, more sectors, right? Competitive intensity is super high, actually increasing. Wherever there are lucrative margins, decent profit pools, there are entries, newer players coming in. We were talking to in the AC space, we had Blue Star yesterday, and we were asking them 65 companies in that space. But just your thoughts on this wires and cable segment, and I'm sure you have exposure.
Yeah.
Broadly, what do you make of it as an investor?
So, Prashant, first of all, let me agree that incrementally, most sectors, we are seeing a lot of disruptions, just not the competition, but also technology disruption, which is taking place. And, a lot of it is actually leading us to sort of go back to, our financial modeling and just see whether, some of this is still making a case. Are the companies losing their core modes? So I think the investment climate overall is becoming very, very challenging, and we have to be sort of very alert in terms of how the companies are keeping up with their competitive modes actually. So that is one very important aspect, especially on the wires and cables. Let me say that I was trying to look for the history when a similar thing happened in case of paints business as such. And when we go back in 2022, when Grasim made that announcement to get into the paints segment, actually we had seen the paints company for 6 months still doing well. Maybe it was because of the demand environment. And only after 1 or 2 years, it really struck that, it's heating up and it's going to be impacting their profitability. So we saw the reaction in the stock price maybe 2 or 3 years down the line, and the stocks, I think, corrected by 30-40%. And this playbook was available as the announcement happened in case of wires and cables. We saw that immediately the stock price actually reacted. So, I would imagine that the business opportunity is going to be large. Today also, when we think about the power sector investment requirement, not only in India, but globally, I think it's going to be huge. And from that perspective, some of these companies would still continue to see maybe decent growth. And the new entrants will also have maybe 4, 5, 7% of the overall market by FY30. But important point is that the stock reaction has already happened this time because the playbook was available. Investors got worried very soon, and 20, 25, 30% reaction has happened. Maybe some more reaction and the stock starts looking attractive from valuation perspective. I would believe that the growth challenge is not going to be there for these companies, and hence at some valuation it would make sense to sort of look at these some of these companies as such.
That's an interesting one. So some correction has already happened, a little more, and then it becomes attractive. Vineet, always good to speak to you. You know, there was an interesting analysis that came from your house, which was when the Midcap index was down almost 23-24% from the highs. The analysis was that about 8% decline was due to earnings degrowth and 15 to 17% was due to derating. Now that we've seen a recovery from the lows of almost 5 to 6%, how much do you attribute to improving earnings prospects and how much do you attribute to, valuations resetting?
So Mangalam, this is all very short term and driven by sentiments rather than any big earning change. I think for me, if you ask me, I still consider that March quarter will be, again, looking like downgrades of earnings from where we were. And this is coming from, the commentaries we are listening from the management. It's a bit cautious. And I think you guys are also talking to the management. There's no real, recovery, which is broadly seen across different segments. And hence, I would imagine that we are still under some risk of earnings downgrades, maybe 1 or 2 quarters more. But good part here, Mangalam, is that, we have seen 4 or 5 quarters of sequential earnings decline. We already have seen a low base creation. And in some form or fashion, the macros eventually should sort of turn as, we see that monetary fiscal, some bit of that space is easing out with the stance taken by RBI. So, and the hope is that consumption should start seeing revival maybe towards the end of this year. So I would say that things can turn around from here. Maybe 1 or 2 quarters of pain. Markets will slightly be ahead of that. And hence today we are seeing these corrections and then bounce backs. But I think there are, from the corporate side, some more pressure points still maybe there in the quarters to come, 1 or 2 quarters.
Vineet, hi. Good morning. Good to be speaking with you on the show today. So since you're saying that consumption is likely to bounce back, let's talk about how you'd play it. And there's been enough debate around it, right? The top-end premium level consumption, but then we got into the narrative of the urban consumption slowdown. After the budget, the narrative changed to that now that there is, people have 1 lakh rupees extra to spend, they'll go to QSRs, etc. So you tell us, what are you convinced about in consumption?
So I think, Surbhi, you're right. It is very unclear and the wallet shares are changing. People are also now traveling a lot. They're spending a lot on hotels. We don't know where exactly the spends are going to take place. But the way to think is that we go back in history and see that. So first of all, we have benefits of taxation. The welfare, schemes are maybe giving some more benefits to the people. Inflation coming down is good for the rural folks because they were affected post-COVID. And I think towards the end of this year, we'll start talking of the 8th pay commission benefit, which last time around, it did help auto sector in a big way. So, instead of really focusing on where exactly we'll see the benefits, I would say that we have to create basket of consumer discretionary stocks as such, because we believe that these are durable. The tax benefit is a durable benefit, and people may want to build these kind of assets where on the discretionary side it can be auto. People may like to spend on hotels, QSRs, and all of those. So we have exposures out there, and we are actually incrementally looking at this space. Maybe retail at certain valuations could become attractive. Right now they are all going through a bit of a slowdown. And what Prashant mentioned, I think one thing which we'll have to keep worrying about is the competitive dynamics across the space, which has become a very important factor to think before we buy with a long-term view.
Sure. So you mentioned that in this basket of discretionary consumption, you'll probably put autos, maybe hotels, maybe retail at some point. Where does that leave quick commerce and the platform companies? Because the problem is their sales numbers were fine, even the profitability looked okay, but now they're reinvesting in the business, they're opening all these new dark stores and the market got a little worried. Where are you on that space?
So there, actually, we are still seeing the competition is heating up, and that may not still mean that these companies will see light at the end of tunnel soon in terms of the profitability, and which is where we have taken a sort of a pause out there in terms of going aggressively on those names. But we are watching that space. We know that, as I spoke about the wallet share, I think they are catering to a big need which is there. Just that need needs to get converted into pricing power, and that should eventually deliver profitability. If that path becomes clearer, I think it would make a good case for investment.
It's interesting, some of the names that you hold in some of your funds, you do have small ticket discretionary items from the consumption space like Safari, you have Thangamile, LT Foods. Interesting, updates coming in from the retail and textile world as well. Vineet, the question I'm curious to know the answer for is, in this decline that happened, did you top up on already existing names, or did you buy something else as well, which was always on your wish list, but because it had run ahead, you couldn't buy it, and now the valuations seemed attractive? If you could give us a sense of what you did.
So a large part actually went into our own existing stocks, because there we already have our own understanding of businesses, and we slightly increased the exposure. And we also took this opportunity to maybe cut exposures in names where we felt that the overall outlook for them would be slightly more elongated in terms of recovery. And new names we keep watching. So as a proportion, I can say that maybe higher allocation to the existing names versus the new names. And new names also are finding their way into the portfolios as well.
What would the nature of those companies look like, the new names?
Yeah, so I think it is to do with where the businesses have seen low cycles. So specialty chemical as a pack is one area. Auto ancillary, I spoke about the auto, but auto ancillary seems to be a better way to play all of these. Some consumer names we are watching. So I think in and around these segments, the names would sort of lie.
All right, Vineet, thank you so much for joining in and giving us your views on the market and talking us through the sectors and stocks that are not specifically stocks, but ideas that you like after this correction itself. But one of the sectors on our radar is the capital markets theme itself. CAMS as a company is on our radar. It signed an agreement with LIC to provide insurance repository services. To discuss this and more, we do have Anuj Kumar, who's the managing director at the company, who joins us now. Basics first, Anuj, thank you so much for joining in. What does this do to your incremental revenue, additional users, market share that comes in, this tie-up that you've done with LIC?
Hey, good morning. Hi, and thanks for having me on the show. So broadly, you will know that the insurance repository has been in existence for over a decade, but hasn't got the impetus and the push that you would expect. So therefore, LIC joining up, I think, is directionally a great thing for the industry, because a large market leader with that kind of market share had stayed away from this architecture. What this does is that we have now close to 80 lakh plus EIA accounts. All those account holders, practically everyone will have an LIC policy. They will be able to bring this into the realm of servicing through that. LIC over a period of time within 2025 will move some of their new issuance. They may not get the legacy policies yet, but the new issuance will start moving into this architecture. So you can have your LIC policies, both new and old ones, as you like, in the insurance account. On top of this, you would be aware that we have Bima Central, which is the unique unified servicing platform, where you can manage your entire portfolio at one go, including transactions over a period of time, lien marking, borrowings, all of those things. All of that will get enabled. So I think it is structurally the right thing to happen for this segment of the industry.
For you, sir, Prashant here, good morning. This is about, the repository is about what, less than 2% of your revenues so far?
That's correct. It's less than just about 2% of our revenues. So
Okay.
I think we are not expecting a large kick-up in revenue because of this.
Yeah. No, LIC, if you just count the number of policies out there, LIC is about an 80% share of all policies. Now, with LIC coming on, as you said, this does shake up things a bit. Would you expect, 20, 30, 35% kind of growth in this business? I mean, from a low base, obviously, that is one. And second is, could you tell us what is the cost of doing? What do you charge as margin on these policies?
So it's a very simple charging mechanism. Every time an insurer brings in a policy, he pays a charge of conversion or dematting, which is between 5 to 10 rupees. And then they charge an annual maintenance, which is also in a similar range. So that is what they end up paying. So the rules of large numbers apply. I would think certainly this business is poised for growth. I can see that number to be in the range of, let's say, 25-30%. For the coming year for FY26. It's also great signaling to the rest of the market, which hasn't yet aligned to this architecture. So you can find that a lot of the others will also start lining up. Just to share, someone like Star Union Daiichi brought in their entire policy base to us last year, which means those are insurers which are complete believers and they want to get into this 100%. I think that momentum will increase now.
You know, NSDL, CDSL, etc. also will start doing this. You've kind of beat them to it in terms of, but do you think it gives you a kind of first mover kind of advantage here?
It gives us the first mover advantage in two ways. By the way, LIC will sign up with all the IRs. It is not that they're just signing up with us. We are the first to sign, but you will see that happen in the next month or two. They will tie up with everyone and give consumers a choice. I think the way this game is played is that the larger number of e-insurance accounts you have, because each citizen is allowed to have one, you can get as much market share as you drive the EIA count, because then whether the person has an LIC policy or healthcare, everything gets into that account. So that's the direction for us to take, to focus on maximizing coverage of EIA and then signing up with as many insurers as possible progressively so that those policies then get inside the EIA accounts.
So just to completely understand the full picture on this, you're saying that this business should grow at 25-30% over the next couple of years. Tell us two things. One, the margin profile of this business and how it compares with, say, the mutual fund business that you run. And if it grows at 25-30%, that let's say by FY27 or so, how much of your total revenue will start coming from this business, and what does that mean for overall profitability and margins?
So this business is a small business right now, like you said, 2% of overall revenue. So think of it as a break-even business. It is not a margin accretive business right now. As we kind of drive the momentum and help this grow by, let's say, 30%, this will get into double-digit EBITDA in the next 2 years. That's our aspiration. It will still not be materially contributing to the overall book. The overall book is very large. You know that we are a company with about 500 crores of PAT. So when it will start influencing, that may take another 3 or 4 years. But from a size and growth perspective, things look pretty strong.
5 to 10 rupees is what you said, sir. Is it 5 or 10? Or is it somewhere in between? What? In terms of what you charge, one time and then annual maintenance?
Yeah, it's not a flat rate. It depends upon what deal you get with individual insurers. It is in that range.
Okay. Also, I mean, you said that it should get to double-digit EBITDA, say maybe by FY27, 28. Overall, you're operating at 40% plus margin. So in that sense, for the next couple of years, this is not really like you're saying, it's not really about margin creative growth.
No, think of this as a platform business. We've laid the rails, we've done the plumbing, we've acquired the customers, and we have the accounts for them to place their policies. Momentum builds over a period of time. That's exactly the momentum we've seen in other platform businesses. So what I'm very positive about is that foundationally, as we grow from, let's say, 80 lakh to 2 to 3 crore e-insurance accounts, the number of policies will multiply. I'll give you one simple metric. Every quarter, we used to get about 500,000 in demat till about a year back. This quarter, that number is 1.5 million. Our objective is that 1.5 million doubles from here in the next 2 years and becomes about 3 million. At that size, this is, it has every kind of, indication to become a large material business for us.
Let's talk about, your core business here. The mutual fund AUM actually declined by 1% month on month. The inflows have been lower. It's a function of the markets itself. And then the most important part, SIP stoppage as well, increased by about 123%. So does that have an impact on your MF business? Are there any concerns on growth out here? And you were also renegotiating a couple of contracts with 1-2 players. Has that happened? At what levels?
So I think the primary metric, which is MF AUMs, have held very well. if you see whatever has gone off 4Q over 3Q, overall AUMs have not declined by more than 3%. Equity has not declined by more than 4%. This is despite that mark-to-market losses have happened over a period of time. One of the biggest contributors is that net sales, which were over 1 lakh crore a quarter, let's say 1.5 lakh crore, held at 1.5 lakh in 2Q, held at the same number in 3Q. I think in 4Q, there'll be a fall, it'll still be over 1 lakh. So a lot of makeup has happened because investors continue to bring their monies into the industry. It is very similar for our assets also. Our equity assets are down about 3% quarter on quarter. Overall assets are down about 2%. So there's nothing alarming there. The real metric you should see is new SIPs, because what's happening on net is that there is some one-time closure of accounts. The industry has been very disciplined in shutting down SIP accounts. If an investor has 3 successive bounces or 3 instances of non-payment, I think in the momentum, some of those closures got delayed. So you're seeing some, over par closures in Jan and Feb. You may see that in March. If you continue focusing on new SIPs, which is a great metric to see, the industry was getting about 2 crore a quarter in 2Q. That number is down to about 1.5 crore. So it's not a bad number at all. From those numbers, we do not see any panic at all. And from a 2 to 3% AUM erosion, I think that's a very good number, which is going on in fourth quarter.
Got it. All right, sir. I had more questions, especially on MF Central. Maybe we should get you on Let's Talk Money for that, because for consumers, for users like us, that's the next big thing that we all are watching out for. But thank you very much for the business update, and look forward to the next conversation as well. Well, let's move on now and put the spotlight on Ceat. That's the next company on our radar. It has launched a new range of tires under the Sport Drive range that includes ZR-rated 21-inch tires, run-flat tires, and low-noise calm tires as well, targeting specifically the luxury and the premium end SUV segment. Our colleague Sudarshan caught up with Arnab Banerjee, MD and CEO of the company, and began by asking him about the launch.
We have launched 3 tires with new technology. One is the run flat tire, which will keep you safe even if the tire is damaged. You can drive up to 80 kilometers and get it fixed. Second is the calm tire, which is a low noise tire, which is becoming very relevant in terms of long road travel over highways, electric vehicles. And the third is a high speed rating tire, Z-rated tire in 21-inch. So all these tires are targeted towards customers who are evolving from just commuting to exploring on the highways, driving electric vehicles, and also off-roading and going long distances. In terms of strategy, we are targeting the premium end of the market, which is about 8 to 10% of saliency in the overall car tire aftermarket. This is going to grow much faster than the rest of the market, and this is going to grow to 25 to 30% saliency. So if we have ambition, and we have ambition to improve our competitive position in the market, then this is a segment where we have to fortify our position. So these 3 launches are going to do precisely that, and there will be many more coming in the near future.
So what will be the price range and any market share that you would be targeting?
See, our market share is about 16% plus overall. So we would definitely like to be over-indexed in this segment. So we would like to have at least 16% or closer to 20% share in this premium segment, which is the 17-inch plus segment, which is what we defined as premium segment is. So these 3 launches are going to aid that process.
So now shifting to operational metrics. So I'll start with the demand issue. And especially on the domestic front, we have seen that over the last at least 2 to 3 months. Now, apart from 4-wheelers, demand has been sluggish even for 2-wheelers. So how is your ground check? How exactly your customers are saying?
So I think you are referring to the OEM demand. So yeah, OEM, I think 4-wheeler has been slow in terms of its flattish, low positive. 2-wheeler has been growing well actually. They've just touched the FY 19-20 levels.
Retail sales, if you see over the last 2 months, it has come down. And in the last conference, these companies, even for FY 26, they are not so bullish.
Yeah. Right. So how we are looking at, first I'll address the OEM segment tire sales. So we had mentioned about exiting some vehicles in the last 2 years, which we did because of reasons that these are not going to grow these sizes of tires. So we are coming back into the OEMs basis the approvals that they've got and the visibility of that. So our growth rate in OEM is pretty okay, even though overall OEM sales is in some segments is slowing down or flattish. That's one. Replacement market size, see the commercial market, commercial tire market, truck bus radial market is going to grow by mid-single digit because that kind of mirrors the GDP growth. The passenger growth has been slow in aftermarket, so we expect that to at least improve to low single digit to mid single digit. Two-wheeler aftermarket growth has been steady, especially led by the scooter tire segment, to about high single digit to almost double digit. Rural market is shaping up well in two-wheeler. So that's the outlook in terms of demand in aftermarket.
So you are confident of double-digit growth that you have been targeting? And
we would definitely like to target double-digit growth because that's been the momentum for the first 3 quarters.
And what would be the range that you will be looking for FY26?
At this moment, I would like to say we are definitely targeting double-digit growth. So let's make it happen. Yeah.
No, from sales, if I can talk about the margin, because in the last conversation that we had with you, you had told that this year margin can be slightly below the last year that you had done.
FY25.
Correct. So if you can talk about the range that you might be seeing looking at for FY25, and also if you can say for FY26, what would be the range that you would be targeting?
Yeah, we normally don't give a guidance on margin. So you have seen the last 3 quarters, it's been around 12 to progressively down to 10.4. I can share with you that the raw material situation looks flattish. So it has stopped escalating or increasing further. That's a good news. But it has not yet slackened or dropped off. So quarter 4, quarter 1, quarter 3, all will be similar in terms of raw material prices. What that means is that there will be perhaps no erosion of margins. And if we are able to take some price increases, they might accrue to the bottom line. Having said that, this is the busy season for tire trade, so competitive pressures will also be high. How much of that margin we can retain in our quest for market share, we'll have to see. But we are inclined to take some more price hikes in small doses much more frequently over the next 3-4 months.
I was coming to raw material prices. So natural rubber, and both if you can talk about natural and synthetic. So what is the range of rubber prices that normally you are comfortable with? And any price, obviously you are saying that you will be taking price hike, obviously it might be some small, but in the last 1 or 2 months, have you taken any price hike? So first, range of that you would be comfortable with, and price hike that if you have taken.
I would share the range of gross margin that we are comfortable with, because we really don't control the natural rubber prices, right? So we are, the least that we are comfortable with is about 40-41% gross margin. We are now about 5% behind that. So to that extent, we need to correct the gross margin. Of course, we are also looking at zero-based approach to the cost structure. So there will be some impact on the cost side as well. But gross margin, there is a clear scope of improvement by about 5%, which will be done through progressive price hikes of small amounts. We have taken some price hikes by the end of quarter 3, by January end. And we expect to take some more price hikes by end of March, and this approach will continue over quarter 1.
So do you mean to say that like rubber price, whatever is the current rubber price, still it's not at the comfortable range that you would say?
It has settled down at a much higher level than last year is the reality, right? And there's a supply-demand gap in natural rubber. So it also depends on how the demand situation evolves. Sorry. So demand situation globally, not only India, but US, Europe, and the Chinese market.
So now coming to export front, because that segment also forms around 20% to your revenue. Now considering all these ongoing geopolitical issues and tariff tantrums, how is the order book looking at on the global front?
See, international business is something which is strategic for us, and we have invested in product development and nurturing Europe, Latin America, and US. We've just launched in US. So it's important, however, it's also most uncertain. But the good thing is that our bets are placed over 3 geographies. Also, Middle East is pretty strong for us. So not everything goes down or goes up together. So we are able to hedge our bets a little bit. Freight rates are coming down. Currency depreciation is good news for international business. So these are the silver linings, I would say. We are getting good market access in Europe. We are looking at growing on a small base in US, so optically the growth will be good. There are some headwinds in Latin America because of protectionist measures. So it's really a mixed bag. And if you're referring to US tariff situation, any increase in tariff has a negative impact on the prospect. But since our base is very small, the material impact, at least in FY26, will not be much.
So in Europe, you're saying that things have improved in the last few months?
For us.
For you? Yeah.
Yes.
Okay.
Yes.
All right, so that's Ceat talking about their strategy ahead as they roll out that new range of tires. We'll take a break on that note, come back on the other side, and we'll connect with Ravi Kapoor of PwC India, as well as Sachin Dikshit of JM Financial Institutional Securities. PwC has come out with a new report on what the rise of quick commerce means on traditional retail. And of course, we'll ask Sachin for some stock ideas as well.
Welcome back. You're watching us here on Corporate Radar, and what a move we've seen on the markets itself. 115 points on the Nifty, though the Midcap index has given up some of the gains. And the reason why we've seen that is because, we've seen some sell-off take place in the wires space, which is accelerating. KEI Industries down 10% right now. Polycab down about 7% as well. Havells continues to see cuts of almost, 4 to 5%. CAMS, we just spoke with the management that stock too is lower by about 2.5%. So maybe some bit of profit taking, maybe some bit of caution. And we are also seeing the Nifty bank face some resistance at that 50,000 mark. The Nifty is holding up because the IT pack continues to do well in today's trading session from its opening levels as well. But let's talk retail. A recent PwC report says quick commerce in India expanded at a growth rate of 73% in FY24. But was that on account of taking share away from traditional retailers, or was that organic growth from all the consumption spaces itself, is the big question. We have Ravi Kapoor, who joins in from PwC, and we also have Sachin Dikshit, who's the lead internet research analyst at JM Financial. Thanks a lot, gentlemen, for joining in. Ravi, three things that really stood out for me from the report that you said. 60% of the traditional retailers perceive online shopping as a significant threat. The second part is that while e-commerce is likely to grow 22.5% over the next 5 years, traditional retail is likely to grow sub 8%. So, what are we looking at in terms of the overall pie expanding, or is it just channel shifting which is taking place? And in light of that, how do you view company strategies?
Well, thanks, Mangalam, for this opportunity. I think the prognosis is very clear. If you really look at the overall personal consumption expenditure in the country, it is growing at roughly around 7 to 8%. So clearly, there is a shift which is happening from our traditional channel mixes going into the organized channels in general, if I call them that, which is a combination of organized brick and mortar as well as the quick commerce and the overall digital commerce players. So clearly there is a move which is playing out in this shift, and what we are seeing here is that, like everything else, it's not evenly spread out. You cannot average out, or you cannot create a macro picture out of this trend. What we are trying to say here is that the way it is playing out for smaller traditional retailers in tier 1 markets, sitting in high SEC localities, the play out is going to be very, very different from when you look at retailers which are operating in tier 2, 3 markets, or bigger retailers where they are much more secure in the way they are able to manage this trend of e-commerce becoming bigger for them. So the hand is not evenly played out. There are pockets where we see this to be much more severe. And what it essentially means for brands is that you need to now take care of more dynamism, more complexity in the way you're looking at your channels. Clearly, we see as the overall growth story of India plays out, we see the organized channels becoming bigger. In fact, our sense is that in the next 5 to 6 years, organized channels should become 30% of the roughly 1.8 trillion retail market that we believe India will become. So clearly, something has to give. And clearly what we see is that the bottom of the pyramid is where the maximum amount of challenge is going to be for Kiranas. And there are ways in which Kiranas will have to really reinvent their business model, and that is what we have tried to cover as to what one can do to really play this out.
Sure, but Ravi, got your point. And I guess that challenge is far more pronounced in urban centers, right? Which is where we're seeing a greater adoption of e-commerce and quick commerce. But back to that central point. So does the report, finally come to the conclusion that right now e-commerce, let's talk urban centers only, that right now e-commerce is not really growing the market. It's only distribution shifting from one channel to the other. Is that what your report is finally indicating?
So it is not exactly that as well, right? Because overall retail is growing in India. Overall retail consumption is growing. Our sense is growing anywhere between 9 to 10% year-on-year CAGR. So overall pie is expanding, but there's a disproportionate shift in certain sections of the consuming economy, which is being taken over by the e-commerce channels. That's the way to interpret it.
I think in that, gentlemen, morning, Prashant here. Ravi, in that report, you talk about the Jevons paradox, right? I think the last we heard that was from, I think, Satya Nadella 2 weeks back, and that paradox shot into fame. But interesting highlights, an interesting report, really. Let's bring in Sachin into the conversation as well. Sachin, good morning. So you heard Ravi, and what does this mean for from an investor point of view? I mean, names like Zomato and Swiggy have corrected quite a bit. Do these trends make these stocks interesting and compelling investment opportunities?
Yeah, sure. What is happening is that most of these stocks, right, Zomato, Swiggy being in the public markets, and then also some unlisted companies that are there, everyone is growing very, very well. And something that's corroborated by Ravi's report as well, in the sense like a lot of growth is coming from e-commerce, where quick commerce is rising in overall mix. So a lot of that channel shift is happening. What we are also seeing is that it's not just channel shift that's happening here. There is also a factor of accessibility that comes into play, right? It came into play in e-commerce earlier. Now through quick commerce, you are seeing that when some of these quick commerce players are expanding into tier 2, tier 3 cities, a lot of the brands that were not present there, a lot of the brands that could not afford to build distribution in these areas are now able to access this customer base, and the customer is able to access those products. So that is also playing out, yeah.
Yeah, Sachin, exactly on that point, Ravi's report, actually, I was going through some of the details, and the report also mentions exactly this, that the quick commerce players, they're finding the difficulty a little more challenging in tier 2, tier 3 as compared to urban centers. That's where they have to figure out inventory management, logistics costs. The market is a little more fragmented. It's not as easy or as homogeneous as, let's say, Mumbai or Delhi. And this is exactly where the store rollouts are happening, right? We remember what Blinkit said and what happened to Zomato at the end of the last quarter. I think it was last, when they said that they will be investing a lot more in the store rollout plan. So given that reality and the whole profitability metrics, do you think that it's good to invest in the companies even as they themselves are still very much in an investing phase, specifically on quick commerce? Sachin?
So what is happening in quick commerce is that you are seeing that a lot of store rollouts are happening. Companies have given guidance in terms of where they want to reach in terms of their store presence. But what is also interesting is that the store rollouts in tier 2, tier 3 cities are very minimal, in the sense like if you look at number of stores per tier 2 or tier 3 cities, that number is probably 10-20% the number of stores that you have in tier 1 cities. So what these companies are doing is that they are looking for basically micro markets in these smaller tier cities, opening stores there. And because quick commerce anyways is a densification play. So that's why that's the approach that they are going to take. And which is why when you look from Ravi's reports perspective, where he might be looking at a broader offline retailer perspective in these smaller tier cities, most of the retailers will not get impacted. It will be just that smaller,
Right. Sachin, what we understand so far from the way any market develops, first is curiosity, then there is denial, then there is, overwhelm, and then there is overestimation. In the Q-commerce opportunity, where are we? Because earlier there was, curiosity whether people want stuff in 10 minutes or not. Then there was denial that, oh, maybe they don't want so many things. Then there was overwhelming stuff that, people are ordering fridges and air conditioners as well. At what point do we lead to overestimation of the market opportunity here?
So some of the overestimation, I'll say, has already corrected, right? If you look at how some of the reports came out in the past 1 year, there were a lot of ambition that was built into quick commerce, thanks to the fact that a lot of players have entered, a lot of profitability guidances have been toned down. So I think we are now, after overestimation, I think that overestimation did happen at some point. We are now reverting back to the norm where the valuations look saner, the estimations look more in line, but still, even today, I think a lot of uncertainty still prevails in this sector because there are still players who are trying to enter and trying to make a dent to the quick commerce landscape. At one point of time, there was only Swiggy, Zomato, and Zepto who were trying to do anything here. Now we are talking about 3-4 players who are trying to make a proper dedicated quick commerce play. Secondly, we are also seeing a lot of the marketplaces in terms of the e-commerce side who are now moving to a 2-hour, 3-hour delivery, right, which again tries to play into that quick commerce arena. So I think in that sense, a lot of turbulence is still there, and which is why you have seen the corrections that have happened. Now the bet is like whether you want to play this sector in the sense like look for who is going to be the winner and try to back them up, or you want to stay away from it. So I think we are still seeing some divergence there. Obviously, people are putting their chips on some of the players, which you can see how the stocks have been moving around. But I think the uncertainty level is certainly higher than what we have seen in the
uncertainty level is certainly high. That is why we got you, Sachin. So from a viewer standpoint, those who are looking at Zomato and Swiggy, what should they do?
So obviously, in terms of where the valuations are, we have very strong ratings on both the stocks. We have buy ratings on both the names. Right, Swiggy's quick commerce play is slightly behind what is there for Zomato, which is why you are seeing that Zomato has picked up in the last few days, and we are seeing Swiggy also remaining. I mean, at least the bottom seems to be capped as of now. But we do have buy rating on both the names, and we believe that quick commerce in this format is going to sustain. There is certainly a market adoption, a customer love that we have seen for the model. So in that sense, I think the story is long enough to be played for some more time.
All right, we'll leave it there, gentlemen. Thank you very much for joining us and speaking to us about what you see as trends here in the space. And we continue this conversation because, of course, I mean, there's a lot happening, newer entrants as well in quick commerce, which we've not touched upon. So people want a piece of the pie, which is expanding. Sachin and Ravi, thank you again. Well, while we've been on that discussion, markets have seen a fair bit of move. So not so much on the Nifty, but the Midcap index. Look at the intraday Midcap index, the intraday small cap index. We've completely given up gains. From yesterday's close to the day's high, the gain was about 1%. We've given back about 1%. from the day's high. I mean, basically the high in the last 45 minutes that we've been trading or so. So it's a pretty steep come down. On the Nifty, you still have 23,000, about 100 odd points higher. And I have to say, even as that's happened for mid and small cap indices, market breadth is still very strong. I mean, I think it's almost close to 3:1. It was 10:1. It's about 3:1. So we'll see and track how this progresses from here. That's a Nifty heat map as well. Mitesh is back with us. Mitesh, morning again. Just a quick view on indices and, of course, what's happening in broader space.
So, morning, Prashant. I think the view remains positive, and as I said, after 2-3 days of nearly 2.5 days of good rally, you might get an intraday dip. But I think for me that would be a buying opportunity. So still, the Nifty has hardly declined from the highs, only about 30-40 points. The Bank Nifty has tapered off a bit by about 200-250 odd points. But I think the chart structure remains positive. So I'll maintain 50,500 as the near-term target for Bank Nifty, and once we clear 23,150, then 23,500 as the target for the Nifty. Very, very clearly a long bias, and in case we get another 80 to 100 point dip on Bank Nifty, I would even want to add on to long positions.
Couple of heavyweights doing well right now. That should aid your call as well, Mitesh. We have Reliance, which has moved to the high point of trade swiftly, and we have HDFC Bank, which saw a dip, and from the lows, that stock has moved higher as well. So just look at Reliance. That may support the cause of the index a little more, and HDFC Bank, which saw a bit of a dip, and that dip too has been bought into. So with that, what we'll do is take a short break. Actually, Mitesh, you have stock picks as well at 10?
Reliance is in fact one of the picks,
Okay.
Very good structure coming out of a good correction. There's a fresh buy with a stop at about 1245 for targets of 1290 to about 1300. And the other one which I like is a tech stock. In fact, technology is trying to show signs of recovery. So Tata LXI is something which has come on the radar. Slowly buy here with a stop below 53.85 and look for a target of around 55-52 billion.
All right, Mitesh, thank you so much for joining in and giving us your calls. With that, we'll simply do a short break, come back on the commodity space. Manisha Gupta gives us a wrap on all things that are moving.
Welcome back. Well, the equity market got a little wobbly on the Midcap index. Let's actually see the Nifty as well. Quick, taking stocks. Nifty's fine. It's the Midcaps where we got a bit of a sell-off. Let's take a look at now what's happening in commodities. We have Manisha joining in. Manisha, what are you tracking this morning?
Well, I'm looking at overall metal as a sector. I mean, we've all been talking about on how gold is trading at an all-time highs, but within the metal space as well, what is really giving tough competition to gold has been the copper prices. Very strong gains onto that one. Let's talk about the macro first, and the US Fed projected slow growth and higher inflation, and we've seen some bit of a buying come into tangible commodities because of that. And then apart from that, there also have been statements from Powell saying that they're not in a hurry to adjust borrowing cost yet, but also said that they're waiting for greater clarity here, but also said that the US Fed could be looking at 0.5% of an increase in interest rates by the end of this year. But let's take a look at copper right now. And even as these statements were coming in, you saw the copper prices gain up by more than a percentage point. So when you look at week-on-week basis, we've seen copper prices gain up by 4%. It's up 13% in last 1 month. And in this year until now, we have gained by 28% for the copper prices. So very strong gains. This is more than what gold has done, more than what silver has done, and more than what various other commodities also have performed in this year until now. So when you look at the spot markets, we have seen that reflect supply tightness. That is because there's a lot of buying happening on LME in Europe and especially in the US markets there. Inventories on LME and Shanghai have continued to see a decline, and the only one place that you have seen inventories actually gain up has been the US markets there. China's special action boost that we saw come in on Sunday also has led to a lot of sentiment buying. The consumer spending in China is expected to gain up with the kind of stimulus measures China is putting out, and that in turn also has been supportive. But you really need to see on what US is doing when it comes to copper. So we are hearing this for last month now, that US could potentially impose tariffs on imports when it comes to copper. Now, US imports nearly 45% of its copper demand, and US copper at this point in time is trading with $1,200 a ton of a premium to anywhere in the world. So US copper is expensive at this point in time. Also, when you look at the US copper imports, they are near all-time highs. So the all-time high that we've seen in sense of imports in any month in US has been 132,000 tons. But there are reports that Trafigura, Glencore, Gunvor Group are redirecting a lot of copper to US from Asian and UK markets there. So that clearly has been supportive. Also, there are expectations that in this month, 100,000 to 150,000 tons of refined copper is being shipped to US. And that is what is commanding premium. That is what is taking the prices on the higher side as well. The markets do believe that we are trading very close to all-time highs when it comes to copper. And if these numbers continue in sense of copper being shipped into US, you could be looking at all-time highs not too far away in sense of copper.
All right. Thank you very much, Manisha, for that. So that's metals and copper in focus. Well, copper essentially is what we are talking about next, but in the form of cables and wires. Stocks are taking it on the chin. One more entrant, large conglomerate making an entry. Vinny's here with a focus on that. Vinny, morning.
Morning. So absolutely, we're seeing a bit of a pressure coming in on all these cable and wire stocks, KEI cables, or even Polycab, Phenolix cables, RR Kabel, all of them under pressure today. Now, increasing competition is the key factor for this. Adani Enterprises has formed the JV for its cables and wires segment, where we're seeing that the 100% subsidiary of Adani Enterprises, that is Kutch Copper, has formed this 50-50 JV with Pranita Ventures, and this is going to be called Pranita Eco Cables. Now, what is this business that is going to be from this JV? It is going to engage in the business of manufacturing, marketing, distribution, buying and selling of metal products, cables and wires as well. So this is very interesting. Now, as of now, what we know, we don't have the details of the exact investment that is happening, but Kutch Copper Limited last year had spoken about, in 2024 sometime, they'd spoken about investing $1.2 billion to set up a 1 million ton per annum copper plant in Mundra. So this is still underway. This is still under development and construction, and that would be making products like copper rods, gold, silver and other copper products. So this is going to be interesting of how Adani Enterprises is going to play out with this and Kutch Copper Limited in terms of what is the exact business that they'll be doing, since it's a 50-50 JV. Nonetheless, just in the month of Feb, we had Ultratech Cement also, who had announced that foray into cables and wires, making that capex plan announcement of around 1,800 crores over the next 2 years. And since then, we've seen all these stocks be under pressure. In the last 1 month, we've seen the stocks fall almost in the range of 10 to 19% for all these stocks. So keep an eye out on that. Pressure surely is increasing, and analysts are saying that this could maybe hurt the industry better, and some bit of the return ratios for these incumbents may get impacted as well.
Sharp fall. Look at that, 12 to 13% down on some of these names like KEI now. Vinny, thank you very much for that perspective. We do have to take a break on that note. Come back on the other side and it'll be time for our special segment. It's the economy. Lata, today we'll discuss Asia macros and markets post the Fed decision with Louis Kujus of S&P Global Ratings and Neeraj Seth of BlackRock.
Well, the global economic kaleidoscope has moved. The US Federal Reserve has upped its inflation forecast, lowered its growth forecast for the US economy, giving a whiff of stagflation worries. But it has retained its forecast of 2 cuts in 2025. More important, I think, is Treasury Secretary Scott Bessent telling Fox News that his government will, on April 2nd, give a number to each country that represents their total tariff wall against the US. But it wasn't clear from that interview if the higher tariffs will be applicable given that number from April 2nd, or whether that number will form the starting point of negotiations. So what does all this mean for Asian economies, Indian economy, currencies, markets? I have an economist, Louis Kujus from S&P. He heads Asia economics, and a market veteran, Neeraj Seth, former CIO and head of APAC fixed income at BlackRock. Neeraj and Louis, thank you very much indeed for joining me today. Louis, first to you. I'll come to the Fed in a bit, but what have you made of Scott Bessent's statement? Do you think reciprocal tariffs don't actually apply on April 2nd itself?
It's a good question. I'm not sure anybody of us knows exactly what they're planning in terms of timing, and not even exactly what they're doing, right? So the White House published a piece a few months ago saying that they consider there to be 7 or 8 criteria that they'll look at when they make up their minds about these reciprocal tariffs. They include tariffs, but also, bilateral trade surpluses, and even things they don't like about your tax regime, or things like when they feel your wages are too low. So we will have to look what they are coming up with, and then make a decision. As you said, also the timing is also not exactly clear.
But Lewis, neither S&P for that matter, yesterday Fitch even published its India growth number. They've retained it at 6.5, and I think your number is also 6.5. The tariffs are not making you revise India's growth numbers?
We actually looked very carefully at which Asian economies we think are most at risk of tariffs, and also where we think if tariffs are imposed, the impact will be the biggest. And, India still has sizable tariffs from a US perspective. So India may well face some tariffs, but exports to the US are not a huge size compared to India's economy, right? So the impact on growth is likely, to not be overwhelming. And that's why we think, yes, India may well see tariffs, but they don't necessarily completely run, of course, that trajectory for India that we're looking at.
Yeah, somebody, I think Citibank calculated that it is only 2% of India's GDP, the exports to the US. Neeraj, the bigger point is, first of all, of course, thank you as well for joining us. What is your sense about US exceptionalism? If the Fed itself is lowering growth rate and upping inflation forecast, and we have seen the stock markets react, is US exceptionalism over?
I don't think it's over, but there's certainly a pause. And I do think markets were stretching the concept of US exceptionalism, which led to a lot of capital flowing to the US from a financial markets perspective at the expense of rest of the world. I do think you're seeing a pause now from a tech, from a future growth perspective. I still think US actually is very well placed, but the market stretched the valuations on the concept. And I do think we are just seeing a recalibration based on the shift in geopolitics, the shift in the US politics and the policy predictability, because the one thing I would say, the only thing predictable today is the unpredictability of the US policy. And I don't think that's going away. So that pause is very well warranted.
Okay. So it's a pause. Maybe exceptionalism is tarnished a bit, but not over. But Neeraj, the bigger question really, which any Indian will ask you, when does the FII selling stop? I mean, I'm asking you also because India's inflation has come in much lower. So the need for the rupee to depreciate any further seems to have gone away. Given that side of the story, do you think we are at least at the end of this outflow from FPIs?
I think we've seen a decent chunk of what I would say what one would have expected. But if you step back and think of the three broad reasons, the valuation is a starting point. When you started to see the outflows last September, the Nifty was about 26,000, and we're seeing close to 28 billion of outflows from the FIIs. The second is the unpredictability post the US election and driven by tariffs and obviously the lack of direction at this point from an investor perspective. And the third factor is the rise of Chinese markets. And we've seen the push from the authorities to revive growth, and the run-up in the Chinese stocks have obviously taken some part of that allocation back. So I think we've seen majority of it, but are we done? I'm not sure, because the predictability as well as the potential for Chinese stocks to do well, at least in the near term, still very much is on the table.
Okay, I'm going to come back to you for a dollar rupee view as well, because the rupee has appreciated 1.7% from the February 10th lows of 87.97. Today it stands at 86.22. But I'll come back to that. Before that, I think another factor that we have to bring in is Europe. The deficit increase and the German Bundestag allowing for the debt break. The German executive is going to spend 1% more on defense. Lewis, what does that mean for global growth? There is a huge fiscal stimulus from a large economy.
Yeah, Germany is still a pretty large economy. So our European economists, they're looking at this. We expect to have to raise our forecast for next year's growth and for 27 Not a lot for this year because it takes a while before this starts to really, affect the economy. But definitely, we're looking at an impact on growth next year and the years thereafter. And it's about time, right? Because so far we've been looking at a really weak picture coming from Europe. So, there are probably, from a business, from an economist perspective, there are probably more productive ways to grow than via defense spending. But at least, we have spending now at higher levels than we were looking at before. So, yes, we are going to raise growth forecasts.
Okay. In terms of deltas, would you say that you would push the Chinese growth higher? I'm not at the moment looking at levels. I mean, it's not 4.5 or 4.75, but is it that India is seeing an outflow because the delta here is not moving to higher? But for China and for Europe, the delta is higher. Would that be a fair observation, Lewis?
I think it's really interesting. There are a lot of things going on at the moment, right? One side is the economics, and then you have financial markets. And I think financial markets have rightly, looked back at India, at China, and said, "Hold on." Some of us talked about it being uninvestable. There's nothing of interest over there. People realize there's a lot going on in China in terms of innovation in tech, biotech, all these things. To be honest, on the pure economic front, on the macroeconomic front, things haven't changed all that much. We're not overly bullish in terms of growth, and we still worry about downward pressure on prices. But yeah, the markets I think markets probably have been too gloomy on China and are having another look at it.
Okay. Yeah, fair point. I guess the property problem is still not over, according to latest reports from the country. You agree with that. Neeraj, now for the levels question. Your dollar-rupee view, as well as interest rates. Do you think India becomes attractive on the rate front? Our last inflation number was 3.6. So, even in terms of debt, does India look very attractive?
I actually do believe India looks very attractive on the debt side. And if you look at the government bonds in India, they are among the most stable when you think about the carry-to-wall ratio. And it's still extremely underrepresented in the global portfolios because of the recent opening of the Indian debt market. So I do believe that's a market which remains attractive. It will be slow, but clearly a story of inflows from the global investors. And from a currency perspective, to your point, I think India is moving towards a structural story of shift in the inflation lower. And I think it's a positive story. So it should give stability from a currency perspective. And one of the challenges I always feel is people look back last 10 years, 20 years, 30 years and look at the depreciation, which was in a very, very different era. Lack of infrastructure, food price inflation, volatility. I think it's changing. So in a medium to long term, I'm positive on the currency exchange rate as well as the Indian government bonds and the broader credit markets in India.
Well, that's important. We were factoring in 3.1 or 3.3%. If I looked at the average of the last 20 years, you're saying that depreciation is not called for when you forecast. Lewis,
it should go lower.
It should go lower. Okay, that's important. Lewis, what is your delta on India's growth? I mean, there are some gloomy predictions that the GST collections, auto sales, etc. February exports and imports shrank. Exports shrank 10%, imports shrank 16%. So is there any downside risk to India's growth?
Downside risks. Lata, I think there are also upside risks. So our forecast is pretty stable, both with regard to how it looked a year ago, and also, so basically it's pretty stable compared to last year, and also we're not planning to make major changes to our forecast. We think that, there have been a few weak months in the second half of last year. It does look like we're overcoming that. So yeah, we don't want to make too big changes.
Okay. Well, thank you very much. I'm out of time, not out of questions. So Lewis and Neeraj, thank you very much for participating in this conversation. I think the takeaways for India look positive at this point in time. The S&P economist saying the growth looks stable in spite of the kind of changes we are seeing in the global geopolitical terrain. And Neeraj saying that India is a long-term, macro story. in terms of fixed income and inflation, and of course, therefore, the exchange rate. Those are positives, long-term positives. Wrap up on Bazaar on that note. Chartbusters coming up.
The Nifty rises above 23,000 for the first time in a very long time. It's led by positive global cues. IT stocks surge as the US Fed holds rates steady. The market has come off the opening highs but still holding about 23,000 for the Nifty. The broader markets, relative underperformer after big outperformance yesterday.
Cables and wire stocks have corrected sharply on intensifying competition within the space as the Adani Group now plans a foray. This follows Ultratech, which announced an entry into the sector last month.
CLSA bullish on Z Entertainment with an outperform rating and a target of 170 rupees a share. The brokerage says risk reward is highly favorable with valuation at rock bottom. The stock surges nearly 4%.
The cabinet extends incentives for UPI transactions up to 2,000 rupees for small merchants. Brokerage Jeffrey says the approved incentives are half of last year and could result in a proportionate fall in adjusted EBITDA. Paytm shares are down by around 4%.
Order wins continue for a lot of the companies as we move towards the end of financial year FY25. Just keep an eye out on Paras Defence and GRSC, Garden Reach Shipbuilders, all of them higher. Paras Defence has won an order worth 140 crore rupees from the DRDO, while Garden Reach Shipbuilders has won a road project in Nagaland, among all the other companies which are spiking. It's a solid start. You're watching us here on Chartbusters. We're live to you from CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormas Fatakia. Across all parameters, the market's doing well. On the Midcap index, one would quibble that, okay, it's not gaining as much as the frontline indices. But my point to them is that 1,800 stocks are still in the green. The ones which are losing, of course, are, on account of reasons that have come by, be it increased competition or be it some regulatory risks that we're seeing in the likes of Paytm, etc. But what's interesting is the previous chart that came up, the Midcap index, briefly slipped into the red from lower levels we've seen purchase. So dips are being bought into, and the broader markets, in terms of market breadth, is strong. The frontline indices continue to rally, Hormaz.
Oh, the frontline indices indeed. 4th day of gains now for the index, now above the 23,000 mark for the first time after the 19th of Feb. So it's good going for the benchmark indices.